Analysis presentation comparing Iacon Group and Bird Construction, the two of Canadian leading construction companies. Iacon is known for its financial stability and controlled debt management, while Bird Construction focuses on growth but carries higher financial risk. In this presentation, we will dive into key financial metrics, cash flow performance, and investment recommendation to determine which company presents a stronger financial position. Now, to start our analysis, I will hand it over to my teammate Bahari. He's going to present the first section.
Thank you, Ahmed. So to start with the first ratio, we will talk about current ratio analysis. In 2021, Bird Construction had 1.21 of its current assets for every $1 of current liabilities. In 2022, the ratio increased slightly. This is an indicator for improved liquidity. In 2023, the progress continued, and the ratio increased up to 1.26, suggesting better short-term financial health. As for Aecon, the current ratio of Aecon in 2021 is 1.46, and it's higher than that of Bird Construction, which was 1.21, indicating strong short-term solvency. In 2022, the current ratio of Aecon declined to 1.27 due to increase in current liabilities from $1.4 million to $1.8 million. This increase outpaced the growth in current assets from 2.1 to 2.3. In 2023, the ratio improved to 1.42 due to the increase in current assets coupled with a decrease in current liabilities. Despite the dip in 2022, Aecon successfully recovered and maintained a stronger liquidity position than Bird Construction. Now, to move to the next slide, we will be talking about another ratio, which is the profit margin analysis. The profit margin ratio of Bird Construction was 1.93%. It increased slightly to 2.1% in 2022 due to a little improvement in their net income. In 2023, the profit margin increased further to 2.56%, a result to the continued increase in net income that surpassed that of the previous year. As of Aecon in 2021, their profit margin was 1.25%. As we move to the next year, the margin dropped to 0.65%. This decline is a result of a decrease in net income. However, in 2023, the profit margin rebounded and exceeded that of Bird Construction. But despite that increase, the ratio did not reach the industry standard. The industry benchmark comparison. The profit margin of the industry recorded 10.16 in 2023. It is significantly higher than the ratios of both Bird Construction, which was 2.56%, and Aecon, which was 3.49. This suggests that Bird Construction and Aecon are generating lower profit margins compared to the industry. There could be some factors behind that. Let's say one of them could be high operation expenses. Now, to move to the next slide, we'll be talking about the return on equity ratio. The return on equity of Bird Construction in 2023 recorded 22.80%. This ratio surpasses the average industry ratio of 19.39. This is a clear indication that the company has efficiently utilized its shareholders' equity to generate higher profits. On the other hand, Aecon's ROI in 2021 was 5.44%, then it decreased further to 3.18% in 2022, before going all the way up to 15.21% in 2023. This massive increase indicates an improved operations and an enhanced cost management. In short, Bird Construction outperformed the return on equity ratio of both the industry and Aecon, whereas Aecon lagged behind both of them. Thank you, and will hand over to my colleague.
Okay, I'm Chell, and I will talk about debt ratios. So debt ratios tell us how much a company assets or funded by debt. A higher debt ratio means higher financial risk, while a lower one suggests more stability. From the chart, you can see Aecon had reduced its debt ratio from 0.72 in 2021 to 0.67 in 2023, meaning it's relying less on borrowed money. Bird construction, on the other hand, remains a higher debt ratios of 0.77 above the industry average. So why does it matter? Lower debt means Aecon has more financial flexibility, allowing it to seize future growth opportunities without heavy interest burdens. And about debt to equity ratios. The debt to equity ratios compares a company total debt to its shareholder equity, indicating how a company is financing its operation through debt or equity. Econ has still steadily reduced its debt to equity ratios from 2.74 in 2022 to 2 in 2023, meaning it's shifting toward equity financing, which is generally safer and more sustainable. In contrast, bird construction has a high and steady debt to equity ratio of 3.42, making it more leveraged and financially risky. So for investor, this means Aecon is becoming a more stable investment, while but higher debt exposure pose potential risk, especially in economic downturn. And about asset turnover ratios. Efficiency matter because it shows how well a company turns its asset into revenue, and the asset turnover ratios measure this. The higher is the better. So as you can see, Econ asset turnover ratio has been improving each year, reaching 1.45 in 2023, indicating better use of its assets to generate sales. However, bird construction leads in efficiency with a ratio of 1.97, meaning it generates more revenue per dollar of assets. Although Aecon lag behind bird in efficiency, its continuous improvement suggests that it is becoming more competitive in asset utilization. And about return on assets. Profitability is key for investor. So ROA measures how efficiently a company uses its assets to generate profit. A higher ROA ratios indicate stronger financial performance. So Econ's ROA jumped to 5.07% in 2023, a major improvement from previous years. This signals a strong recovery and better profitability. Meanwhile, bird construction has shown consistent profitability, but just with a stable ROA of 5.02%, but it hasn't experienced the same level of improvement as Econ.
Thank you. Uh, the equity multiplier, which measures how much a company relies on debt to finance its assets. Bird construction has constantly higher values, indicating greater debt usage. Aecon, on the other hand, has steadily reduced its multiplier from 3.74 in 2022 to 3.00 in 2023, showing a shift toward lower financial risk and a more balanced equity debt ratio. This suggests that Aecon is managing its leverage more conservatively, making it is a more stable option compared to bird construction. Thank you.
Hi, my name is Mitali, and I'm going to be now we are going to be assessing the cash flows. And the first one that we are going to talk about is the operating cash flow. So let's begin with this and compare the cash flows for operations for Aecon and bird construction for the last 3 years. So in 2021, Aecon reported an operating cash flow of 65.6 million, which was higher than Bird's, which is at 48.1 million. But still, that was below the industry benchmark of $60 million. And by 2022, Bird Construction saw a sharp rise to 92.4 million, surpassing Aecon's for 69.9 million and reflecting improved collections and project completions. However, in 2023, Aecon made a significant leap, reaching to $140.2 million and outperformed both Bird, which was steady at 134.5 million, and the industry benchmark, which was at 120.3 million. This indicates that Aecon had strengthened the financial position and driven by improved working capital management and project execution. Now, let's move to the next one. For the investing cash flow, let's talk about the overall industry comparison with Aecon and Bird again. Aecon followed an aggressive investment strategy in 2021 and also in 2022 by spending $130.6 million and $203.3 million respectively, focusing on infrastructure and market expansion. However, in 2023, it reduced its investments to 45.7 million, emphasizing asset sales and financial stability. Bird Construction maintained a more consistent investment approach with cash outflows of 56.2 million in 2021, 65.3 million in 2022, and 50.1 million in 2023. So when compared to industry benchmark, both the companies aligned closely in operating cash flow by 2023. However, Aecon's initial aggressive investments positioned it for a stronger operational growth, whereas Bird pursued a steadier strategy. Ultimately, both the companies demonstrated strong financial management, with Aecon pivoting towards stability after significant investment-driven expansion, and Bird maintaining a balanced approach throughout. Now, Ahmed will be taking it over again.
Thank you, Mithali. Looking at cash flow financing activities, Aecon faced significant financial challenges in 2023 due to the debt repayments, but it mitigated the impact through preferred share issuance. In contrast, Bird Construction maintains stable financing outflows, indicating a more consistent approach to managing its financial resources. And moving to the other slide, please. Moving on to the life stage determination, Aecon is transitioning from growth to maturity, showing strong cash flow and clear debt reduction strategy. On the other hand, Bird Construction is a late growth to early maturing phase, but it carries higher financial risk due to its debt reliance. Next slide, please. In conclusion, Aecon stands out for its superior leverage management and financial stability, while Bird Construction remains profitable but with greater financial risk due to its reliance on debt. These distinctions is crucial for investors. Those looking for stability would prefer Aecon, while risk-tolerant investors might see Bird Construction as a higher growth opportunity. Finally, I would like to talk about the investment recommendations. In our perspective, Aecon is preferred choice due to its lower financial risk, stronger profitability, and consistent operating cash flow growth. Bird Construction, while offering aggressive growth potential, comes with higher financial uncertainty. Overall, based on our analysis, Aecon presents a more stable and financially secure investment option. Thank you very much for your attention. That will be all. Thanks, everyone.
Thank you.
Thank you. How